And what I'd like to do now, if that's okay with everybody, is I'd like each one of you to tell us a little bit about yourself and your company, and after that, we'll start with at least one question and open it up. So, Andrea, would you like to go again first?
Thank you. Hi, I'm Andrea Himmel, Chief Investment Officer at Himmel Meringoff Properties. We're a 40-year-old, vertically integrated, long-term oriented, and hands-on owner-operator of one of the largest privately held portfolios of office buildings in Manhattan and warehouses in the boroughs. I run our acquisition strategy. All of this resonates with me that you've mentioned, just because I'm on REBNY's diversity committee, so that, legal outreach, that's very relevant. Board of Habitat for Humanity, so affordable housing is something I really care about. But we're really focused on office and industrial, and that's where I think I can add value to this conversation. I think a lot of office is going to have to be repositioned and reimagined, potentially rezoned, and there needs to be more collaboration with the city and politics, and I'm excited. We've always been long-term holders in New York City and in emerging neighborhoods, and we continue to see actually New York City as an emerging neighborhood because the office headlines are so ugly.
Thank you. That's awesome.
Hi, good morning, everyone. I'm Rashid Walker. I am the founder of First Street Capital, which is a real estate private equity firm focused on investing in multifamily properties in and around New York City and infill locations. I'm originally from Long Island. I still live on Long Island. And I love New York City. I've had the pleasure of covering the eastern seaboard of the country for a large pension fund advisor, and I will tell you that New York City is by far the most resilient market in the country. I think, Shimon, you talked about, some of the assets or cap rates in other markets. The one thing that I've noticed throughout my career is that you can have, the best building outside of New York City. You've got to have, let's say, the trophy asset in Charlotte, North Carolina, for example. That may trade like the average New York City market. And New York City is so resilient. There's always liquidity in our market. We love it. We want to take advantage. We took advantage of a lot of the dislocation that we saw in the market. Just been through enough cycles to know that you never bet against New York. So we're excited about what's going to happen going forward. We've seen rents increase, obviously, and that hasn't been the best for housing affordability, but it's been great for investors. But I'm just excited about what's going to happen throughout the rest of the year and going forward.
Thanks a lot. Hi, good morning, everybody. I'm Will Blodgett, the CEO and founder of Tredway. First, I'd like to thank Shimon and Ariel for having us all here, and I'd like to thank everybody here for coming. I'm still not sure why people come to hear me speak at these things, but here we are. So I started Tredway back at the beginning of 2020, focused on multifamily housing, specifically affordable workforce, mixed income. We look at the stuff we buy through two basic lenses. First lens being, does this actually promote upward socioeconomic mobility, right? And that can be in a whole host of ways, right? I was born pretty poor on the south side of Chicago. We used to go outside and see the guys on the corners, selling drugs, etc. And when I'm trying to buy and build and preserve is housing where the kid who's, coming down the elevator, instead of running into the guy in the corner who perhaps is selling drugs, is now running into the guy in the corner who's getting on the train and he's coming here. And they start a conversation on the bus, what's your name? What do you do? And he's like, I'm in real estate, et cetera, and it sparks opportunity and it sparks imagination and it sparks exposure. The second lens that we look at our investments through is through, does this have a good, in our eyes, risk-adjusted return? And if the deal meets both of those tests, right? Does this deal actually promote upward socioeconomic mobility? Does this deal have a good risk-adjusted return? And that's all, a whole host of factors that goes into that. If the deal hits those two tests, that's something that both myself and my team will begin to spend a tremendous amount of time on. I started here, in NYC back in really 2006. Took all the stuff that we learned here with all the various affordable housing programs, agencies, et cetera, and we started to spread that all across the country.
Thank you, Will. And you teed up the next question, which is really interesting. I mean, we're in a kind of uncertain period where we're trying to figure out what's going on. So how do you guys look at what you want to invest next, in your investment criteria, what assets you're looking into, and what locations? Anybody?
I'm happy to jump in because I'm aggressive.
I love it.
Let's call a spade a spade. We still see New York City office as a really attractive opportunity, but not spaghetti at the wall style, but really selective in what we have been known to do, which is an emerging neighborhood. So I'll give you an example. We were in Harlem in 1979 and in Long Island City in the 80s. 4 years ago, we bought an 8-acre industrial site in the Bronx. And for us, I think the opportunity will present itself in the following manner, which we're already seeing some signals of. And it's really, the distress really hasn't been realized yet we're in the B market, secondary building market. The distress, it's been realized there, but it hasn't been realized because lenders have been kicking the can down the road. Now that they have lenders and now even equity investors have new requirements, lenders for reserves, equity investors for what % they invest in real estate, and with stocks down so much, real estate has risen, so they're trying to shed it. New York City office is an ugly word, so it's a 4-letter word, so we see the opportunity in good buildings, good light. Number one, is it leasable? Number two, what's the seller profile? What we're seeing is a lot of mom and pop owned buildings. So say it's in a trust, 20 family members have to make, they've always received for the past 30 years distributions from the building. And now suddenly the building is 40, 50% vacant with 20% rollover, and they're gonna have to put in $300 a foot. And that's just between CapEx, TI, and leasing commissions. And that means that, the guy who owns the bookstore in Vermont who inherited his interest, he doesn't want to put in, 15 million or 5 million or what. It's just, so the opportunity will be people who need equity, because this is really not a crisis of debt, although debt replacement will be an issue, but this is more a crisis of vacancy. And countervailing that is within our own portfolio. We've signed 1 million square feet of leases in the past year, 3 or 4 of which were 100,000 square feet or larger for 15 to 30 years. We just inked a deal with Mount Sinai for 30 years. It hasn't been announced yet, for 50,000 square feet in our property on 57th Street that's Life Sciences, and 100,000 square feet to the NYPD. So at least
Hot off the press right there.
yeah, that's
Hasn't
an announcement. And
breaking news.
breaking. That's our nerdy version of breaking news. But we're also seeing opportunity in the industrial space, and that's a harder asset class because Amazon toured every property, and so every owner thinks, oh, I can get 35 triple net and sell it at a 3 cap. So we focus in that area on owner-occupied stock. So we bid on a plastic injection molder who makes Frisbees and water bottles, bid on his business, the operations, in order to access and monetize the real estate. And so we can be creative and flexible, and I think this coming cycle with the distress that will be manifesting, especially with interest rate hikes, just yesterday up 75 basis points.
Yeah.
We're prepared to jump. We still, it's only in the past 2 weeks that we've seen prices become realistic, $400 a foot for a secondary building, that's well located but has 30% vacancy. On that, you can get probably SOFR plus 600 and at a 60 or 65% LTV. And, but before that, SL Green is marketing paper on a SIT building on Fifth Avenue for $1,000 a foot. That's just unrealistic, right? But we're seeing opportunities that we think will arise in New York City's recovery.
So really leveraging your platform and your tenant relationships to
A lot of our
buy in.
tenants have been with us since the 80s, 70s, and we're long-term patient. We can arbitrage time because we don't need current income if we're low basis buyers. So that's our strategy.
It's great.
If I could, Shimon.
Yeah.
I think that there's a huge opportunity going forward in the AC rehab space, right? Especially in affordable housing, of course. I always come back to that. But we're currently short right now in America. We're currently short about 3.8 million apartments, right? That's growing at about 250 to 300,000 per year. It's not coming in; it's actually expanding, right? There are currently in America about 45 million existing apartments. Over half of those apartments, over half of the 45 million existing apartments are over 25 years old, right? So, and we have about 100 million Americans, or about one third of all renters are currently rent burdened, right? We're only building a year in rental housing about between 250,000 and 350,000 a year. So when you hear those stats, the opportunity set becomes clear, right? We're 3.8 million apartments short. That's growing. We're only building between 250,000 and 350,000 new rental units a year. We have 45 million existing apartments. Half of those are over 25 years old. We need to start to invest in the stuff that we have and come up with different ideas and think outside the box and be creative and work with agencies via public-private partnerships to acquire, rehabilitate, and create or preserve a very significant level of affordability. Because otherwise, if we continue going down this trend, that at the end of this road is not a very pretty picture.
For us, we only focus on, multifamily, so that's just, that's our niche. This time that we're in right now kind of reminds me of, around the GFC, when, things were really crazy, people were nervous, and, at that time I was, working at, JP Morgan, and what we said was like, okay, it's now time to get back to the fundamentals. And, before the GFC, people were going in, moving further and further away from the subway. There was so much money in the market. You started building, wherever. And right now, I think the opportunity in New York City is you just got to kind of be patient and wait for the right site. I think I've seen so many folks just start to push the boundaries of, what's a good neighborhood in New York. And, for us, we just start to focus on sort of those core neighborhoods. We stay focused on walkability. How close are you to the subway? How quickly can you get into the city? Although, this whole CBD thing is changing now. Like, is Manhattan still a CBD? Yes. I think it will come back.
By the way, if you look at the USPS change of addresses for people who left New York, the preponderance, although some didn't go to Austin or Miami, they
Right.
went to New Jersey, Long Island,
That's
and
right.
like within an hour in Connecticut, Westchester. Yeah, I lost a lot of friends to Greenwich and Westchester in the past year.
I agree 100%. When we're looking at a site, as a matter of fact, we tied up a site on Long Island, walking distance to the train, right? So, again, it's just really back to fundamentals. Stay close to transportation, and be patient. I think good sites will be available, and that's what we're doing. I think we just see the opportunity in New York and the surrounding markets as fantastic, and again, it's really going back to the fundamentals and not making the same mistakes that we made, before the GFC and saying, yeah, there's this farm next door, but we can develop that. No, I think it's sort of back, to infill locations again near transportation.
100% agree with you, and I think something that we're seeing affordable housing, right? Like as I mentioned earlier, I grew up poor, South Side Chicago with a stutter, right? And a whole lot of my friends lived in the Chicago Housing Authority, and those are my friends. And one day my friends were there on a Tuesday, the next week on Thursday my friends were gone, and they tore down the Housing Authority, and they rebuilt this stuff out on basically what is farmland, right? And it was blight on top of blight, and I think everybody now agrees that that was an unmitigated disaster, right? And building on what you guys are saying, right? It's not just about high quality, right? It's about high opportunity, right? And the opportunity means, are you around eds? Are you around meds? Are you around infrastructure? Can you get on the bus, or can you get in the subway and be at your office in under half an hour, right? Is there an opportunity, for your kids to go to a very good school, right, and start to actually, climb that ladder of upward socioeconomic mobility? I think it is about, from a true overall investment standpoint, coming back to the actual fundamentals. But it's also about focusing not only on the fundamentals, but ensuring that it's high quality and high opportunity.
And Will, you mentioned some statistics about the shortage throughout the nation, the shortage of housing. What do you see different investing? What's the difference between investing in New York City, or the opportunities from your perspective to invest in states outside of New York City?
Look, I started my real estate career here in New York City. This is home to me. I'm involved with, a whole host of organizations here, and this is the place I love, right? And it's kind of like everything else in the country, like it starts in New York City and it spreads elsewhere, right? We kind of set all the trends here. I think one thing that has to happen in New York City is you got to start to pay people at the agencies a lot more. You have really, really smart, super hardworking people at the agencies, and I think there was a pretty big article the other day in the New York Times about a guy that worked at HPD, right? And their hearts and their heads in the right place, but we have to. Speaking from a person that actually, I spent a year and a half at the NYC Housing Authority, right? There are great, smart, hardworking people there. I think, I took the, experiences I had here in New York City and the stuff that I learned here in New York City, and we started to take all that and apply it elsewhere. And so far, that has proven to be, like a pretty overall both successful and impactful strategy.
If I may add, we just invested in a platform of workforce housing in Phoenix. And I'm bringing this up not because of this deal, but because of the thesis and the themes around that. Workforce housing, you know, I was just in Telluride, Colorado, hiking, and the labor there lives an hour away because the city blew up just like Austin, Nashville, all the places we've seen just explode in the past few years, and it became more expensive, pushed out local residents farther and farther. So we think that there's demand, there's, to Will's point, certainly demand for workforce housing, and you know, if you can get it right, you know, and it's simple. We're just buying existing assets, fixing them up, adding a washer dryer to the unit, you know, something simple value add improvements, which is consistent with Himmel and Meringoff style, and you know, experiencing that growth and, you know, being in an area where the growth is there. Because New York City, as much as I sing the New York City office song, it's work from home is a real issue for office landlords, and a secular trend that seems to be permanent over time. And you know, as we face these headwinds in New York City, we have to look and be creative and look where there really are headwind opportunities.
Thank you. Stay on that topic for a second about the office, because it's interesting. I mean, Google invested $2 billion in buying St. John's Terminal. They're going to put another $250 million. They're calling it a ground scraper because it's going to have really big plates and you know, outdoor spaces and amenities for their workers. I don't think they're building an office. I think they're building a home, right?
They're building a
their
campus,
employees.
yeah.
Right. But you know, we also saw Rob Spire talk about his tenant HSBC, that he's going to one of his buildings and he has a studio as the co-working that he uses, or it's theirs, and they say that it allows for more flexibility for HSBC if they wanted to expand and so on and so forth. And I know you work with WeWork on 1460 Broadway, I think, and other places. What do you see happening in that world of office? Do you see, what are the changes that you think are going to take place moving forward?
So we're lucky our occupancy in our portfolio returned to above 90%, but physical occupancy is still lower. But WeWork always ahead of us. So we're one of WeWork's top 5 landlords in New York City. One of our buildings is fully leased to them with Foot Locker in the base, and they have the rooftop, and it's one of their best performing buildings. So for them, we've actually seen, you know, when New York City was at 40%, they were available of people going into the office, they were at 60 to 70%. It depends on the location. We also allowed them to terminate a lease, which was a more recent lease that they did with us on 32nd Street. So, you know, they're taking back space selectively. I think they're focused on where they have letters of credit that are significant that they can't afford to take down. But 45 million Americans are freelancers, or 50 million, and that's about 40% of the labor force. So if you think about the freelance economy and how many tenants went out in the past 2 years saying, we're going to not have an office, we'll reconfigure, we don't know what size will be, smaller or bigger, let's just take a break. A lot of those people are going to WeWork, and I think it's you know, obviously the company grew itself in a kind of reckless way, but the fundamental concept of flexibility in office space, especially when companies are looking into a recession, maybe grew in the past few years, maybe shrank, and they don't know the prospects of the future. So, you know, this is tech earnings week. You know, we get to hear about Google or Alphabet and Meta and how they've performed. And why does that matter for real estate? Well, Google's the largest advertising platform in the world. That's their business. And if their earnings are down, that means that ad spend is down. And ad spend is a corollary of GDP. So it's a good leading indicator of how businesses are doing. So when spending slows down, you see Google, you see Amazon, you see Meta, all that sort of Twitter, you see that as an early indicator reflective of potential recession coming. So I think a lot of those folks who aren't ready to commit because of recessionary fears and, interest rates going up, they're coming to the WeWorks.
Thank you. I think, Rashid, you are committed on 111 Washington, together with a partner there, right, to
Yes.
develop. Tell us a little bit about that project and what's going to happen.
Yeah.
I think you bought it well.
Yes, we bought that well. We got a little lucky, I think. And it's a great site downtown Manhattan. And it's, again, obviously in the city, and we took advantage of the dislocation in the market at the time. New York City was over, right? In 2020 and 2019, and people were thinking, oh, it's done. We're all moving to Miami. And again, I've just been through enough cycles to know that New York is never over. And there were 4 months of free rent being given at the time. And we bought that property, and knowing that, this market is going to come back. And the rest is history. I mean, it's tough, though. Construction pricing is really high.
Right.
But,
Do you see that changing?
Yes, I do. We do see, not fast enough, however. But I will tell you that, when we acquired that project, our general contractor had escalations at around 10, 11%. So they're backing off of that now. It's probably about half of that. So it's gotten a little bit better. But I think for certain things, it's still an issue. And there's also a little bit of price gouging going on too, from some of the subcontractors, some of the suppliers, I should say. But yeah, no, it's a great site. And just going back to why New York City, I think New York City is again, it kind of reminds me of like that old boyfriend or girlfriend that you had before you got famous, right? And you liked him or her because they were really nice person, and they had just great, outstanding qualities. Then you got famous and rich, and then you just started to look around and say, I'm going to date a few more people, right? And then times get hard, right? You're like, that person was really cool. Let me see if they're still around, right? And that's what happens in New York.
Perfect
I would tell you
metaphor.
that, if you look at other markets outside, I remember selling stuff in the Southeast. And I will tell you, when the market got difficult, we would fake it, and we would say, oh my gosh, we've got, 2 buyers, and one of them better not fall out.
Yeah.
But when you're in New York, you've got a lot of people that come to the party.
Yep.
And again, that's why New York makes a lot of sense. But, and back to 111 Washington, that's why we took advantage of that. It's like, New York is not in trouble long term.
Yeah. I would never leave that girlfriend, by the way.
A funny metaphor.
She sounds awesome.
A funny metaphor, because you just brought up such a great one, is in the industrial space. If you look for prostitutes, because they show you where truckers go, and trucker demand reflects industrial activity. And so if you were in Hunts Point, for example, a few years ago, before Amazon kind of made a campus there and stuff like that, you would have seen that as a leading indicator. So it sounds crazy. I don't promote it. I don't have data to support it. But there you go.
That's pretty interesting. That's great. That's great. You do anything you can to find the
You
right
got to
deal.
be
I think.
creative.
Yeah, you got to be creative. That's wonderful. And then you have to bring
best
the right
panel ever.
capital, into your deals. And I know, Will, you know what? Will, let's talk to you about capital. I mean, I think that the capital that invests in multifamily and workforce housing and affordable housing, I think has changed over the past a few years, a decade or so. I mean, what do you see when you talk to capital about investing in your projects, either in New York City or outside? What are they looking for?
Sure. So, you still, like, it hasn't actually changed that much. So you have the players that have been there for a very long time, right? HUD, Fannie, Freddie, a whole lot of other people from the equity side that have always been the affordable housing. What has changed is more people have come in, right? Kind of making, putting the words affordable housing in a bunch more headlines. But going back to what Rashid was talking about, the actual fundamentals are still there. And, you know, what we do a lot is we do, tax-exempt bonds and local housing tax credits, right? You still have the same groups that are buying your local housing tax credits. You see, you have the same groups that are, buying or issuing your bonds. There is a more heavy emphasis now on ESG, right? So CRA, for those unfamiliar, it's the Community Reinvestment Act. And by being involved in the capital stack in affordable housing deal, usually helps to meet those needs. But that's kind of always been the case. I think now there's just been an added emphasis on it, which I think is great. I think, affordable housing is starting to get, but not scratching the surface, the attention that it should be getting, because it's such a huge need. And it's not just a need for, people making, 50% AMI or 60% AMI. It's a huge need for people making 100% AMI, right? It's very hard to live in New York City and to be in, what we were talking about, the high quality, high opportunity areas making 100% AMI. We need different types of public-private partnerships and different types of actual programs to encourage or perhaps even require new sources of capital to come into the space to help build the affordable workforce, mixed income housing, and to further promote upward socioeconomic mobility, right? This country was founded on the premise of upward socioeconomic mobility, right? And there are three key tenements to that. It's housing, education, and healthcare. I think without housing, education, and healthcare, are as important, because the housing is the floor. It's your home. It's the foundation.
Yeah, you're running for an office.
Speaking of, you brought up capital raising for
Yes.
residential, affordable, and I was going to add that just yesterday, I forget which index, but not something with NAREIT, or I forget, added single-family residential rentals to the list, which means that now all institutions are going to have an investment in a bucket. So we're going to see a flight of capital, even though we've already seen a lot of big billion-dollar funds invest in single-family SFR. I think that is in its early innings, because it's now going to have to be included in tremendous amounts of investor buckets.
Yes, and then to build on that, there's also a lot of investment in 2A and 2B here in the city, which are units below 10.
Yeah.
And some institutions are really getting into that space, which is also super interesting.
I would tell you that I think that, so I do a lot of fund investing, through a fund, I should say, and then also direct deals. I think there are two different investors. I think the type of capital that wants to go into a direct deal is, you name it, JP Morgan, Carlyle, everyone else. I think those that want to go into funds are a little bit different. They're often foundations, those that can't necessarily get access to that institutional quality real estate that's out there. So you'll find a lot of the families that are in New York. But also, I found that there are people that get New York, institutional investors, that is, people that get New York and those that don't get New York.
Can you introduce me to the ones that get New York, that have the cash, courage, and conviction to go
Right.
long New York City office right now?
Well,
Nobody.
that's tougher. But I do think that, that you've got, I've spoken with some potential investors, and they're saying, oh, we're afraid of New York. We're staying away from New York. We don't get New York. And I would say that New York City is great only because, well, for a lot of reasons, but one of the things with zoning, right, you kind of know what you can build. I worked on a project on Long Island for 7 years to try to get zoning. Wow. It's ridiculous. And, Long Island has an even worse affordable housing problem than New York City does, because there are no nice apartments on Long Island. I lived there. And
That's how you got to know Bram Weber.
that's right. That's how I got to know Bram. But I think that, the type of investor, if you're interested in coming to New York, if that institutional investor wants to be here, I think they're usually those family offices and foundations are quicker to invest alongside you.
And to Will's point about just the dearth of incentives right now to build affordable in New York City, I'll give you an example. And you talked about transportation ridership coming up. There's 4 new train stops coming to the Bronx, and one of which is in Parkchester, and it sits on our industrial site. So we're part of a master community rezoning where we could build 2 million square feet of residential. We have a 300,000 square foot industrial warehouse in it now. It's worth more as industrial today than if it were affordable housing or, had an affordable housing component. As a Habitat for Humanity board member, I think that is backward, right? Like, we should be incentivized, not disincentivized, from building 2,000 units in an area that needs housing. It is going to be 20 minutes to Penn Station, opens up a whole new access line, and provides employment opportunities.
Yeah, you bought 1601, which is.
I just want to say that Andrea Himmel, who specializes in office, I think knows more about affordable housing than me, so you should just ask her all the questions.
No, I told him to say that, but yeah. Thank you all.
No, I think you bought 1601 Bronxton, which I think you just alluded to.
Yeah.
This is a fantastic site, lots of acreage and a lot of potential. The business plan right now is to keep it industrial until something happens.
Yeah, so it's 8 acres, 325,000 square feet of a warehouse, first floor, 175,000 square feet ground floor warehouse, 1 loading dock per 5,000 square feet, 25-foot ceilings, good column spacing, 50 by 50. So it's got the infrastructure for industrial. We bought 2 adjacent parcels to accommodate further ingress, egress from 53-foot trailers. We had a tenant who had a renewal option that they exercised, so we're tied up for the next, call it decade as industrial, but then have the ability, when the train is ready around 2027, we'll be teed up for developing that residential. Hopefully at that point, resi will be worth more than industrial in terms of encouraging us and our partner to, do the right thing.
Thank you. And I think we have one question that we got from before from the audience about the 421A. Anybody can answer it, but the state took away the 421A, the tax abatement that encouraged residential rental to be built. And as I said during the presentation, it's just not economically feasible to build rentals without it. So, and we need a lot of housing to create affordable housing. What's going to happen with that?
I think the affordable housing crisis will get worse.
I don't know, I was just with someone from DCP, Department of City Planning, and his view was, obviously it's a hard time now without 421A, but something's going to replace it. Whether that's better, I don't know, but something will. There's catalysts for change and city support.
I think something has to replace it. We went through this before, right? Was it 7 years ago?
Right.
This happened, and
2015. Yep.
And so we've seen this story, and we lost 421A for about a year and a half or so. Nothing got built, and we started with this whole affordability housing crisis, right? Guess what happens? You start limiting supply, you're gonna start having issues. And I think that's what will happen. I do think it will be replaced at some point because you cannot build in New York City under the current tax structure without a tax abatement.
What about conversion? Like Garment District should be converted.
I view, personally, I think conversion
It's
is
expensive, though.
It's expensive and it's very risky, and you never know what's behind those walls.
You think it's viable to convert office, for example, into residential, or you see this?
Silverstein is doing that right
Yeah.
now with the building they bought from Rudin, converting it to resi.
Yeah, I think.
But it's a heavy lift. You need
It's
a low
heavy
basis.
lift. You need a very low basis. I think I toured recently the Waldorf Astoria. Right? What do they have, a $2 billion cost overrun? Problem is, you just never know with some of these older buildings when you start, tearing down walls, what you'll find inside. And you can't account for that in your underwriting. You can give yourself a major contingency, huge contingency, but that makes the deal tougher to pencil. I hope we can start converting some of these office buildings. I personally view it just as very, very risky. and I'm biased, I just started from ground up development.
You want to do ground up, yeah.
I just rather
lot
do
easier.
that. I kind of know
Just
I'm going to
like-
put the latest, the newest, the best systems in there in a new building. And I don't want to have to worry about, I think at the Waldorf there was something in every hotel room, something in the drains or something,
Yep.
some type of contaminant, right, that they couldn't account for. And I mean, can you imagine having a $2 billion cost overrun? I
That's
mean,
huge.
that's
We
just,
converted some stuff, and like, you look at the plans, and you go on the walls, and it was like, what is this? It was complete apples and oranges, right? Going back to the capital question, though, one thing that's interesting is there is a lot more impact,
Impact capital, mission driven.
yeah, impact capital, mission-driven capital, and it's not just about the housing, but it's also about energy and sustainability. And when you come in and you do ag rehab here, right, when you think about it, 60% of the Earth's carbon emissions are from the actual built environment, right? So when you think about, okay, in this country right now, we have 45 million existing apartments. Half of those are over, 25 years old, right? If you get the money and the impact capital and the ESG and the bonds and the credits and the whole thing, you put that all together into your overall capital stack, right? You have the opportunity here to basically reduce your overall energy consumption,
Right.
by at least 1/3.
I'll
That's
add
huge.
to that. Heinz is building 355 Greenwich, I think that's the address, fully electric with geothermal. Geothermal is a natural source of energy. My background is in below ground real estate or oil and gas. And geothermal is fascinating, and I think it's probably the future of electric buildings. But it requires drilling holes in the ground, and you can't bore holes in a city where there's buildings next to you, or it's where it's highly dense. But I do think that, and I think, I think net zero targets are all impossible to achieve. 20% of our energy still comes from coal, and people think natural gas is dirty. It's actually going to be an important source of baseline supply for energy. So I think the energy targets, they're important. You can reduce your energy costs by like 40%. But for us, we think we pass it on to the tenants. I mean, it can be their decision. So it's a hard question to balance.
Yeah, and there's also
And you're
secrets.
speaking there to an MIT trained, right, MIT trained physicist, right, Andrea?
Yeah.
You are, yeah. But the best way to build.
That was Will, he is.
No, you are, right?
I'm not a physicist.
What are you?
I still figure in and out.
All right. Anyway.
I started at a hedge fund and then ran a private equity fund.
No, but you went to college for what?
I went to Wharton undergrad and I studied real estate.
Oh, sorry.
There you go.
But we
Way-
go back. We're
way
still
off.
friends. We're
Wharton's
still
the
friends.
best.
But the best way to create a clean building, right, is, I agree with Rashid, is you got to build it. You got to, just a whole lot of this stuff. Like, the only way to do it is,
It's easier on new construction
Yeah.
than existing.
Okay, I'm going to ask a wrap-up question from everybody and just project what's going to happen in New York City the next 6 months. We're going to stand here again somewhere at the end of January or February, and we're going to see what happened.
Can you turn off the camera first? You put that back up on Meet the Press, right? I think New York City will, continue to be, the global city that it is. Real estate will continue to do multifamily. I'm speaking from that perspective. Will continue to, perform very well going forward. I think that, the work from home environment that we're in right now it bodes well, obviously, for real estate. So I think that if I'm an investor, I want to be in New York City real estate. I was speaking with an economist at a major bank, and and they're based in the Southeast. And he mentioned to me that they have been making offers to newly minted MBAs, and they pay the same amount in Charlotte, where they're based, as they do in New York City. And they still have a tough time getting their students to go to Charlotte.
Wow,
So I think young people still like New York City.
the demand is here.
The demand is here.
I think a lot of New York City is going to be reimagined and repositioned. It may not be in the next 6 months. I never pretend I can time anything because we're long-term investors and owners, and timing on market is you can't catch a falling knife. We're still buyers today at $400 a foot for an office building that's well located. But where in the cycle we are, I humbly acknowledge I can't tell you where that is, but I do think that landlords who are facing capital calls and then debt refinancings in the next 6 months are going to be stuck because they're not going to be able to refinance their property because it's now half empty and the LTV is too high. They don't necessarily want to part with the asset. So I think those will be the source of sort of sales in New York City. Obviously, there's the Class A that's bifurcated, that's getting a lot of attention. But I think we're going to start to see transaction activity in these buildings where there are just a lot of CapEx burdens.
I agree with what everybody said here, that I think that NYC is the greatest city in the world. I think it is the greatest city in the world, and I think everybody, has aspirations of being here and coming here because it really is a springboard, right? I mean, think about how many hundreds of thousands and millions of people, came here to America seeking the American dream, right, of upward socioeconomic mobility, and they came here first, right? And I think what we're seeing in New York City is we're really seeing a gap between the haves and the have-nots. And I don't know what's going to happen in 6 months. I'm certainly not smart enough to predict that. But I think that, if this city remains the place, is to remain the place where people come to, start their career, to start their lives, as a springboard to go off and do amazing things with their lives, we have to have things in place to reduce that gap between the haves and the have-nots, right? And I think the absolute most important way to do that is to, the 3 key tenements: upward social mobility, healthcare, education, housing. It's housing. And I think if the city is able to enact Mayor Adams' pretty ambitious housing plan, which Shimon, you started on at the beginning, right? If they're able to execute it, that will go a long way in reducing that gap between the haves and the have-nots, and will keep this city the greatest city for all, both the haves, the have-nots, and everybody in the middle, right? And I think that is key, and that's not something that we can all lose sight of.
I love it. I think I love hearing that New York City is long and everybody's believing in it long term. This is exactly what we think, and I think that the demand factors are here to support it. Got to tell you, I really enjoyed speaking with you. I mean, it's been just great listening to you. You each do a lot for the city and in general in investing in real estate. I want to thank you. Thank you, Andrea. Thank you, Rashid. Thank you, Will. Thank you for taking the time. It's not taken for granted.
I learned a lot from your market overview, so we got to do a deal together.
Absolutely. We look forward to that. That's
learned a lot from
exactly
you
what we're here
guys.
for. Thank you, everybody, for joining us. There's still more food and networking, so go enjoy.